Hey there, it's Russ here from Tactical Mortgage Solutions. In this video tutorial, we're going to help you set up your prime rate forecast so you can compare fixed rates to variable rates while using a forecast, a variable rate or prime rate forecast. So in here, if you're new to TMS, then the first step is that you would not have any strategy sessions created. So if you haven't, then let's create one. So we want to create an account, and I'm just going to say Sydney Crosby. And I'm just going to say his email is sydney@sydney.ca. And I'm now going to create an account. So now I'm in Sydney's account. Now I'm just going to create Bank of Canada rate forecast. And I'm just creating a strategy session just so I can do this quickly, and then it'll show up in every other one. So if I go down to mortgage product options, you can click on the plus, and then you can hit any variable in here, CMLS, Scotia, anything. I'm just going to use Scotiabank in this case. Now, as we go into the product options, you click on the rate, and then we can click on prime rate forecast. And what I'm going to do is I've created some in here already, but we can do is create forecast, and then you can edit it. And in this case here, what I've been doing is putting BOC forecast, and I'll put a date in here so I can go back and see what the forecast is the last time that I had updated it. So at this point in time, where I'll reference is I'll go to this here, which is the market participant survey, and I'll do some quick little research here of, what the expectation of the prime rate is going to be. Right now, 3.25% is where we sit. And in about a year, it should be about 0.5 to 1.25% lower is what the anticipation is from the Bank of Canada website. I'll also do some research here, and a lot of us get these emails already, is I'll look at these here as well as the policy rates, Q1, this is the overnight rate, and even some of the economists that are out here. This is kindly provided by Ben Rabideau. And I'll do my research, and then what I'll do is I'll pop back into TMS. And then what I'm going to do is, this is what I'm anticipating. We are sitting at January 22nd, so I anticipate the prime rate is going to fall by a quarter. I think it's going to fall again. And then they're going to take a break for a little while. And then we're going to go negative 0.25 in September. They take a break, and then we do another one. And I'll save that, and then we'll pop into another one. I created another one called No Forecast. And this is really just if you want to toggle back and forth from having a rate forecast to having no forecast to show clients, then you can do that there. And then I'll add a conservative one. And what I'll do is I'll probably end up going 0.75% on this one. And this is going to change as the market changes. Okay. This one here, I'm going to go 0.75%. And I'm going to push this out a little bit. I'm going to save that one. So this is now, you can have up to 3 of these. Okay, so I'm going to save that. And now what you can do is, let's just fail one out quickly. And what we're going to do is compare a variable to a fixed. So I'm going to go 545, and let's just say this is negative 0.6 right now. And what I'm going to do is I'm going to save this because I've chosen the prime rate forecast, a conservative forecast. And then it'll show up here. Now, if I want to change that, then I can just pop over to here, BOC forecast, and do the one with more drops. Now, if I would like, I can now go like this, duplicate column, and now compare a variable to a fixed. I can update the rate plan. Let's say we're going to RBC. And we compare this to a 3-year fixed. So now what will happen is we're going to compare a 3-year fix, but we have to adjust the term lengths so it compares over 3 years. So in this case here, when I walk through with a client, I can now show them that, look, the difference between a 3-year fixed rate, let's just say it's 4.39 right now, and a variable of 4.85 is going to be about $5,000 higher with the fixed rate. Now, if I would like, and I mentioned that we can go no forecast, I'll talk to the client about, if we compare 485 to 439 without any rate drops, then of course the fixed rate is going to be about $6,600 lower. So you save total monthly payments, the outstanding balance at the end of the term, and the total interest paid is going to be about $66.87 lower than with a variable. Then I'll look at what if we factor in these prime rate decreases. So once we factor that in, then what we can see is that it is higher by about 5,000. If you really want to show the client more details, you can click on the schedule. You'll see the rate, you see the amortization, and also the payments. And you can also show them that, especially if this is higher, the payment over here, the variable, is you can show that as the rate begins to fall, the payments will fall. So that's a quick tutorial on this section, the mortgage product options and setting up your prime rate forecast.